to minimize your risk. Now, Bollinger Bands are a very unique indicator. It's one of the most popular indicators in the markets today, and it's created by John Bollinger. And one of the things that makes it unique is John Bollinger is still around. He's still active in the markets, and he actually operates a website that's called what? www.bollingerbands.com. And he's still active. He's still publishing papers and writing information and conducting seminars and classes. So this is one of the few indicators you can actually get guidance, not individual personal guidance, but guidance directly from the horse's mouth. Now, Bollinger Bands are unique in many ways, but they're an indicator that helps us see if stocks or assets or Forex or CFDs are trading in overbought or oversold territory. Now, there's been an abundance of information published in the internet on Bollinger Bands. Before the internet, books and there's so many gurus and strategists that are trying to sell you their own system or their own modification of Bollinger Band, or you do this, and when Bollinger Band says that, you buy or you sell. There's all kinds of this discretionary material out there. You can go in the markets and read it all, or you can go to bollingerbands.com and read what John Bollinger says. Now, tonight, I'm going to teach you the standard uses and standard settings for Bollinger Bands. Any modification beyond that would become your personal modification, or this guru that's out there telling, well, adjust your setting, this and adjust the setting. The fact is, he knows in his head what he's doing, but he might say when this happens in the market, that happens. But there's no history. There's no millions of people using it that way that you can check and find. So either you've got to back check what this guy's saying and make sure it actually works and works on a consecutive basis in the market you're looking at, or go on his word. And what did I say about trading on somebody else's word before? Now, Bollinger Bands can be applied in all markets. It works great in equities, Forex, commodities, futures. Now, one of the nicest things about Bollinger Bands compared to a lot of indicators and oscillators we get out there is that Bollinger Bands works in any time frame, and it quickly adjusts to short-term time frames or to hourly time frames. And remember, a lot of these indicators and oscillators were adjusted or built or created back when the markets were slower, or there was just stock trading, and they've been modified for today's type market. Bollinger Bands has always worked in any time frame, and therefore they are historically checked and correct. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a trading band. Now, trading bands or envelopes serve the same purpose. They provide relative definition of high and low. Now, that can be used in a very rigorous trading approach. It tells you if the price right now is very high, the price right now is very low, okay? And it actually gives you a point at which you can decide whether the market's about to flip or switch, and it gives you boundaries around price. It envelopes or forms an envelope around price. So before we go on, let's go over and look at some charts, because otherwise it gets very boring. In fact, instead of going to explain all this to you here, I'm going to do it on a live chart so you can see where we're going with this. Hold on. Let me pop up some charts here for you. Okay, so we are currently looking at the Euro-US dollar one-day chart. Not for any reason whatsoever, okay, except this is the chart I had up and this is the chart I'm going to show you. Now, Bollinger Bands are an indicator that is placed over top of the current price. It's one of the few indicators that's not placed below the bottom of your chart. It actually, and one of the nice things about it is because it's placed over top of the price chart, you're actually reading price action along with the Bollinger Bands. Now, as you can see, this Bollinger Band consists of the blue upper and lower borders, and the blue in between, the light blue, is just a background. It's a shading to let you see it better. It's got no value. And then the middle line is a standard moving average. It is the crux of Bollinger Bands. Bollinger Bands is all based on this moving average and the band above and below. So this chart that's up on your screen right now, you see this orange line? That orange line is called the basis band. It is a standard moving average of a 20-period close. That's all it is. If you all should know how to computate or put a moving average on your chart. That is the basis point of the Bollinger Band. From there, we then do a calculation that is quite involved, and it's called standard deviation. Now, standard deviation is a term or a formula used by statisticians in many, many ways and many, many fields. Standard deviation was not developed for the Forex market. Standard deviation is used by statisticians for many, many things. Now, once we calculate these standard deviations, we use them and we place a band above and below the moving average based on that calculation of plus standard two standard deviations and minus two standard deviations. And I'm going to get over in a minute and explain to you what a standard deviation is, but that's what you see. So the difference between this moving average and this upper band is two standard deviations. The difference between that moving average here and this band down here, the bottom band, is minus two standard deviations. Now, you do have to understand what a standard deviation is. And I'm going to try to explain it to you so you do. You'll never have to do, in fact, the mathematical calculation is so complex that it's always done with a computer. So you'll never have to calculate it because it's one of the standard indicators. You just click on your indicators and it's going to drop you off on the screen. And the standard is a 20-period moving average based on the close, two standard deviations above and below. Now, there's gurus out there that try to tell you to use a 20-period moving average based on the open, or the open, high, low, and close divided by 4. Or they'll tell you to use an EMA instead of an SMA. All these gurus praise their own things. There's even gurus out there trying to tell you to use 1.5 standard deviations. But that's not the standard calculation. These are all their modifications. And if you notice, you can easily today adjust all of those things. We can change our standard deviation input to whatever we would like. We can change our center moving average to whatever we would like. We can change the source of that moving average to whatever we would like. But once we change those, they're no longer John Bollinger's Bollinger Bands. And how the other interpretations fit it is up to you and the guru who's trying to show it to you. Own interpretation and your own back testing. So let's go over and first understand what the standard deviation is. And you're going to be surprised that when I explain it to you in what I think are layman's terms that you might comprehend, because it took me a long time. You might comprehend what it's trying to do for you. So a Bollinger Band consists of the middle band, which is a moving average, and the upper and the lower band. These upper and lower bands are set above and below the moving average by a number of standard deviations of price, thus incorporating the volatility. Okay, how does it incorporate the volatility of price? Well, interesting, in the real world, no statistician would ever calculate standard deviation. The calculations involved are somewhat complex and make a high risk of making a mistake. It's also very slow and time consuming. Now, in its simplest form, okay, a moving average, which is the center point of this process, is the average of all the data points in that given set. In other words, in its simplest form, the mean, and what's another word for mean in mathematics? The average is simply the average of the data points. So you would take the data points, the close, the close, the close, and divide it by 20. Oh, come on, let's get back here. So the standard deviation is calculated based on the mean. The distance. So first we calculated the mean average. That is the moving average in the center. From there, a standard deviation is calculated based on the mean or the average. The average distance. The average distance of each data point from the mean is squared, summed, and averaged to find the variance. Or to put it in other words, variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of these, and then taking another mean of these squared. The deviation is simply the square root of the variance. Well, what's the variance? The variance is between the high, the low, the open, and the close. That's the variance of that price in that time frame. If you were to take the average of those and then plot it against the distance between that and your moving average and then double it, you'd have 2 standard deviations. You do it -2, you'd have -2 standard. So what it's doing is calculating the average between the open, the high, the low, and the close for that data point, which is that time frame that you're looking at. But then it squares them and does, but it's looking at all the price movement you had. Now, doesn't it make sense if you were to take some calculation and come up with all the variance between the open, the high, the low, and the close in that time frame, and then plot it against what the average price was? That would tell you something significant, because just the close doesn't tell you that much, just the open doesn't. But if the price in that, say, that 1 hour time frame sailed all the way up and then went all the way down, but closed pretty much where it opened, your close average would be pretty much to zero. But when you take in effect that it got pushed all the way up and then pushed all the way down and then ended up closing pretty close to where it opened, you've got some valuable information. So you'll never have to calculate these. All you have to do is remember that the middle band is a 20 base, and the middle band is usually a 20 period moving average. The upper band is spread above the moving average by a volatility known as standard deviation, and the standard is set to 2 standard deviations. The lower band is the exact opposite, is less, or -2 standard deviations. And so that forms the envelope, or the upper band and the lower band of that Bollinger Band. Middle band, upper band, lower band. Now that we have these on our chart and we kind of understand what we're looking at, how can we use these Bollinger Bands to help us? Well, we have several different ways. Bollinger Bands helps us through pattern recognition. Yeah, you know what double tops are on Head and Shoulders and double bottom. Well, with Bollinger Bands, we get what's called the M and the W formation. It also helps us see early reversal signals, and I'll show you that on a chart shortly. And it also helps us analyze the trend and to detect whether the trend should be continuing or ending. Now, there are many ways to use Bollinger Bands, but it's important to note that when the price touches the upper band, that doesn't automatically mean sell. Similarly, if the price touches the lower band, that doesn't automatically mean buy. In fact, take it from John Bollinger himself, who said, there's absolutely nothing about a tag of the band that in of itself is a signal. And there's too many really basic, not gurus, but websites and simplistic literature, and there's so much blog stuff out, where there's some blogger who's not a financial analyst who's told to write an article on Bollinger Bands, and they look up 10 other articles and they write a 500 word or 700 word summary that's very basic. And what they tell you is when price hits the upper band, buy. When price breaks the lower band, sell. That is farther from the truth than you can imagine. So let's go over back to the bands and take a look at them. So let me pop them back up here for you. Okay, now we can see on this chart. Now you have to remember the only place and the only way you can trade is here and forward. You can only trade at the window, the wall. You can only trade where price is now. What happened back here in price might tell you something, but you can't make a trade based on this. You can only trade going forward. And the only way you can do that with Bollinger Band is to practice them long enough and look at them historically enough that you feel comfortable with what you're seeing at the wall and what you're trying to interpret. Now, if we look at how price is moving, here we see price going down, and what the band does is starts going down and riding along price. Okay. Now, it doesn't have to bounce in and out of this lower band, but price should always be trying because the bands are adjusting continuously, but price should always be trying to touch that band. When we see price get rejected by this band, that tells us that trend might be in trouble. It doesn't tell us anything's happening. It's a forewarning. One of the most reliable ways to use the moving average of the center line or the basis line is once price is rejected by a band and crosses that line, the moving average line, then you know that this trend, this downward movement has ended. It's over. It may come back down and go down a little, but it's over. This is the point when it crosses that you would want, if you had a short sale and you were taking your profit, this is the point where when you see price coming down here, you're not sure. Okay. Now you have some general knowledge here. You have some, here we have our resistance level here, and we would expect price to hold this resistance level. Well, it gets stuck there. So you're sitting back saying, well, should I get out or is it going to continue down? What's new? When we see it break the moving average of the basis line in the Bollinger Band, that's telling you get out of that trade. Now, this trade moved on and on and on over some time frames, then pushed up and tried the best you could to touch that upper band. Tried to move into a backward uptrend to move back here. Couldn't make it. The bears then took back the market. And at this point, when it broke that moving average again, you could then go into a short period while you watch it ride the bands down. Once again, we see price rejected by the outer band. But again, until it broke that moving average, we weren't sure if that trend was over. And then look at that. It broke this moving average and moved into complete sideways congestion. Now, we have a push back up and breaking the upper band, but again, it was rejected, but still came back down here. But now it's done nothing because this is the most, at this point on this chart, was the most current time frame. So we would project based on where price is going, we would like it to see go back up there, but it's still in this congestion mode and we're waiting for something. But to trade this, we had to be sitting right here because we're only trading into the future. Okay, now by trading into the future, and this is today. So by trading the future, right now we're below the moving average. We're not in the markets. We got out of the markets way back here. So we're looking to get back in. So what we're looking for is price to push back up to the upper band or push down to the lower band. We're waiting for the Bollinger Bands to tell us what to do. So I just want to clean this up. Now, we have other combinations. We can use Bollinger Bands. Also, we can use them Bollinger Bands to set our potential take profit level. And we can use the Bollinger Band to set our stop loss level by looking at how, and this is called riding the bands, when price moves up and rides along the band. But we see in here, price is pushing to higher highs and higher lows. And what we would want to do is put our stop loss slightly below our highest low, and then take our profit point based on where the band would push to the next level using other pieces of information. Here we combine it with a chart pattern and other pieces of information. Bollinger Band there is no freestanding indicator that's going to tell you exactly what to do on its own. It gives you points. It will help you set your target point. It will help you set your stop loss point. It'll tell you when to take action. Because if you've got a trade all set up and you're waiting for a clue to when to enter that market, the cross of the basis line is the clue to take that action. If you were in a trade, get out of that trade. If you're looking to get in a trade, okay, it's now time to get in that trade. Now, let's go back to my PowerPoint for a minute, and we're going to talk about pattern recognition with Bollinger Bands. Now, prices can walk the band during strong downtrends or uptrends. This means that there are repeated instances of price touching or breaking through the lower or the upper band. That's why you may want to take action when the price touches either band and might instead prefer to wait to look for a double bottom, or what we call the classic M, or the 3 push high formation. Okay. So looking for this is just like looking for head and shoulders, so to speak. It's a slow pattern that emerges. It's a reliable pattern. I find that I never use it because it takes way too long to develop and way too long for my type of CFD trading. But what you would have is, this is your W formation. The M formation is the exact opposite. You would not see this first leg at all, but you see price moving down. Price gets rejected and moves back up, gets rejected, move down. You would not see this development until you get what we call the N formation. It's the third leg, and when that third leg bounces off at a same level as that first bounce off, you have an N formation, and it starts moving in the opposite direction. It's forming that last leg of the W. So when you have the beginning of the second bottom and the bounce off, it's telling you that there's an opportunity for a buy. You would wait for it to cross the moving average or the basis line, and then you would initiate a buy trade. But of course, you want to set your target point and your stop loss point. But it's a fairly reliable signal, but it takes a long while to develop. And we have just the opposite, which is the M formation, which is where you would get a short position. So remember, this is always coming off of a downtrend, and will tell you when you can get an uptrend. Now, the markets could reverse in between, just like a head and shoulders, but you form this N. Now, this N could be a steep N, or it could be a little N, but it's still an N. So the classic M top is formed by a push to a high, followed by a sell-off reaction, and then a test of the previous high. The second high can be higher or lower than the first high. Watching the price behave like this, a trader may wonder if the stock or the asset is in a new uptrend, or if it has met its resistance, and the Bollinger Band will help answer that. So here we go, the reverse. What we're coming off is off of an uptrend. It makes the top here, gets rejected, comes down here eventually and forms a new bottom, gets rejected, moves back up here to form a new top, gets rejected, and it starts moving down. Well, now you have your upside down N, and the N is the key. And at this point, when that N forms the in this case, the M, and breaks that basis line, that gives you a sell signal, or the point in which to initiate the sell. Now, Bollinger Bands also is one of these indicators that works very well in combination with other indicators. Bollinger Bands and RSI are like the perfect match made in heaven. Okay. And there are two types that you might want to know about. Okay. The 3 pushes high. When we get the 3 pushes high, it tells us we're moving into a longer term top formation. We will also, in combination with RSI, get a buy signal. Okay, we talked about walking the bands. Bollinger Bands can also indicate the end of strong trends. Strong trends cause an expansion of volatility. Okay. So the why, okay, and what I haven't told you yet, the wider the bands, the more volatile the market. When the bands start getting narrow and contrite, the market has very low volatility. When the market starts to expand in volatility, the bands get wider. So when you see extremely wide bands, you know, price is very volatile. When you see extremely narrow bands, price is not so volatile. So that helps you in understanding how you have to set your stop loss, because in a volatile market, in other words, wide bands, you need to set a farther stop loss. When the markets are kind of contracting and they're not in high volatility, you might want to set a closer stop loss. Now, volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. In other words, the markets will only stay so long in narrow volatility, in slow moving markets. They're eventually going to break out of that contraction, and when they do, they break out usually and form a volatile market. So there's something called a Bollinger Band squeeze, which is a very easy strategy. Whenever you see the market pulling tight and congesting, and you see those bands getting very narrow, we know, don't know when, but we don't know which direction, but we know sooner or later the price is going to break out of that band, either upward or downward, and the band is going to start to get wider. That gives you a trading opportunity, and you would trade in the direction of the breakout of the band, of the breakout of the basis. So if price breaks down through the basis and the bands get wider, that means volatility is picking up, means more trading action, and it gives you an opportunity for a short squeeze, short trade. So this is known as the Bollinger Band squeeze, because you see the volatility is low. And remember, since volatility is mean reverting, it means the bands will probably expand, signaling a potential for an explosive move. A simple way to spot a squeeze is when the bands are at their narrowest they have been for many months, many weeks, many times, depending on what time you're trading, and then they start getting wider and signaling the start or the end of a trend. So as you can see, Bollinger Bands can be useful by themselves. But remember, too, that they can be also combined with other indicators. Since they are pure price indicators, you might want to consider combining them with volume indicators for even more depth and insight. Ultimately, there's no indicator that guarantees you'll get in at the bottom or out at the top. However, Bollinger Bands, especially when paired with other indicators, such as chart patterns and recognition tools, you can help make better trading decisions. And one of the more interesting ways to use Bollinger Bands and explained by John Bollinger, is to use multiple time frames. In other words, you can build your bands on a 30-minute chart, a 1-hour chart, and say a 3-hour chart for our type of trading, and use them overlaid on top of each other and find some interesting significant points. So there's many interesting ways we can use Bollinger Bands. And again, by themselves, they don't tell you, they give you some general information, but you can't just exercise a trade because the price was rejected by the top band and then went down through the basis band, and so you should initiate a sell. You can't do it without analyzing price action, without looking at support and resistance, without looking at other pieces of information. But Bollinger Bands will give you some significant help in making a successful high probability trade. Thank you very much for joining us tonight, and have a great trading week, and we'll talk to you next week. Thank you now. And don't forget, if you have any questions, type them in and they will be forwarded into our financial analyst team, and you will get a personal answer back. So just type them into your question screen in your on your screen now. So have a good night, and thank you very much for joining us. Bye now.